I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us.
I thought so too. Anyways, I definitely go and invite you to check that out on Planet Microcap podcast. We did an awesome conversation. And now he's here today to share with you an idea. So we have Jordan Zinberg from Bedford Park Capital.
Thanks, Bobby. And thanks for having me today. It's great to see so many familiar faces in the room. For those who don't know me, I've spent about 20 years on Bay Street with a focus on small and mid-cap stocks for most of my career. In 2018, I founded Bedford Park Capital and launched the Bedford Park Opportunities Fund. The fund invests exclusively in Canada and primarily high-quality small and mid-cap stocks. Our approach is based on emerging growth stocks. So we run a fairly concentrated portfolio. We try to get on stories early, get to know management well, establish positions, and then ride those companies as multiples expand, as others become familiar with the names. I'm excited to get a chance to speak to you today about one of the top holdings in our fund, but before getting into my pick, I thought it would make sense to go through our investment strategy so you can understand how we look at the world. So, as I mentioned, we invest exclusively in Canada, and on the left side of this slide, you can see how we break down the market. So we've got about 4,000 public companies. We strip out energy and mining. That was a bad decision this year, but most years that works out pretty well for us. So we're suffering a little bit now, but I think we'll be okay. From there, we're left with about 700 companies that have market caps of 100 million to 5 billion. Why do I choose those numbers? At 100 million, the companies are big enough, have enough track record, we can evaluate them properly. At 5 billion, everybody probably knows about them already. That's not to say that we won't buy companies under 100 million market cap or over 5 billion market cap, but for us, that's really the sweet spot. So out of those 700 companies, we follow about 250 names, as close as you can follow, 250 names. And then from there, we end up with a portfolio of about 25 stocks. So that's how we look at the world. On the right side of this slide, you can see what we look for when we look for companies. And for those who know me, there won't be any surprises here. So the centerpiece of everything we do is high return on equity businesses. That's my favorite growth metric. And you'll see our portfolio full of high ROE stocks. The next thing we want is an attractive valuation. And I think that's one of those things that everybody says, but nobody explains. So I'm going to explain that a little bit. We don't look for cheap stocks. Typically, to get the growth we want, those stocks aren't cheap. What I want is a valuation that's reasonable, attractive, relative to the growth rate. So if the growth rate's really high, we'll pay up. If the growth rate's a little lower, we won't. We don't expect to find growth stocks at distressed valuations. Once in a while, we do find that, and the one I'm going to talk about today is almost there, but generally, we can't find that. When we do, it's pretty exciting. Another key component for us is high inside ownership. We love founder-led companies where the management team owns a significant stake in the business. We generally shy away from companies that are run by professional management teams where they don't own any stock or they own 3% of the business or something along those lines. The last piece of the puzzle is share price momentum. We like to buy stocks on the way up. We spend a lot more time buying stocks that are hitting 52-week highs than hitting 52-week lows. So now you can see how we look at the world, what we look for. The next slide, I just talked briefly about our playbook, and we really have three main plays. The first one is compounders. I don't think I need to explain that too much. Everybody knows what those are, companies that have a long history of compounding capital at a high rate. The second bucket, and probably the most exciting and interesting bucket, is what I call emerging compounders. So these are companies that have high growth rates, but they just don't have the track record of the companies in the first bucket. And these are the ones I was talking about where we try to find them early and hopefully ride them for many, many years as that growth continues. The one I'm going to talk about today actually fits in that bucket, that emerging compounders bucket. The third one is a bit of a general term, special sits. It can encompass a lot of different things. I've listed some of the tactics up there, so I won't spend too much time on that. I was actually going to talk about a different company today, and This has never happened to me before. I do a lot of these kind of conferences. I'm always picking a stock or two. So 2 weeks ago, I had finished the deck, and I called Bobby, and I told him what stock I was going to pick. And then I came into work the next day, and it was announced that company was being taken out by one of its largest customers. So I was a bit pissed off because I had to do the deck again, and I had to find another name. But for those of you who are wondering, and I see a lot of guys in the room who followed this company, that company was Tornado Infrastructure. So got taken out, transaction's not done, but I didn't think you guys would be that interested in a stock that's already being acquired. So I decided to go back to the drawing board. And since this is a microcap conference, I was looking through my list and I was looking for microcaps. And I was trying to pick one of our microcap names that would be exciting. And when I looked down our book and I looked at the risk reward, it was actually one of our larger names, which is still a small cap, but large for us, that I was excited about. So I love microcaps as much as anyone in this room, but we're going to go a bit larger today. And just before I get into the name, I'm going to talk a bit about the sector, because I don't usually talk about sectors, but this is actually an interesting one where we've made a lot of money. And that sector is diversified financials. And why have we done so well in this sector? Well, everyone in this room knows that Canadians love their banks and they love their insurance companies, and their portfolios tend to be full of banks and insurance companies. So what ends up happening is people don't really move down cap in this sector because they don't need more exposure. And that's where the opportunity is, because if you move down cap in this sector, what you find is a lot of highly specialized businesses, and they usually have really high returns on equity and they have high margins, but they tend to trade at low multiples because they're either underfollowed, misunderstood, ignored in some way. So we've done really well here over the years, and these companies are usually things like asset management, specialty lenders, institutional financial services, things of that nature. So the one I'm going to talk about today is a specialty lender, and it actually has microcap growth rates, and it has a microcap valuation, but the market cap's $1 billion. So why does that happen? Well, usually that happens when companies are underfollowed, or they're illiquid, or they have complex accounting, or they're in a sector that people just don't like. So what I think we're going to talk about today is a company that I like to call the best house in a bad neighborhood. And the name of that company is Propel Holdings. So for those who aren't familiar with Propel, it's a consumer finance company, and they provide customers in the US, Canada, and the UK with fast access to installment loans and primarily lines of credit. And the business is growing extremely. And the way that it grows extremely quickly is through technology. So what they have is an AI-powered underwriting system that's focused on fraud prevention and reducing loss. And it's important to note Propel is a completely online lender. They don't have any physical branches at all. So their underwriting engine looks beyond traditional credit metrics. So as you guys know, most banks look at things like credit scores. They actually don't look at credit scores. They look at thousands of other variables in order to judge the creditworthiness of the customer. And they also do very small loans, which makes the book very diversified. Now, you might be wondering why banks don't do this. Well, the reason banks don't do this is because they're still stuck with human underwriters. And when you have human underwriters, you need to do big loans in order to get your margins. So what Propel's been able to do is leverage technology in order to make underwriting small loans profitable. And the way that they do that is by stripping out human underwriting. So they've been doing this for about 14 years, and they use all of their data from 14 years of lending. They've done about 1.4 million loans. They use all that data to help underwrite the customer and hopefully get better credit performance. And so far, they've been successful in doing that. Their average loan size is about $2,500, and most of the loan book is in the US, although they do have a small loan book in Canada. They're not really focused on Canada because our government came in and capped interest rates a couple of years ago, so it hurt profitability. Where they're really focused is growing their presence in the US, where the loan book's about $500 million. And then last year, they bought a company in the UK. And I'm going to talk a little bit more about the UK because I think that's a big part of the story that everybody's missing. But for those of you who don't follow the stock, I just want to highlight a couple things on the chart before we move on. The company went public in 2021, $9.75 a share. Basically traded sideways for about 2 years, and then in 2023 it just took off. The stock went from $6 to $42 earlier this year, so it went on quite a run. After Q1 of this year, it's been pretty rough, as you can see from the chart. Came down in Q1, rallied a bit in Q2, back down again. It's almost been cut in half. And I don't really have time to take you guys through all the reasons today, but needless to say, I think what we have here is an exceptional growth stock that's trading on a very low valuation. So let's get into that a little bit more. I'm going to summarize the thesis really three main areas. The first is growth, the second is valuation, the last is catalysts. So talking about growth, traditionally growth has been driven by their US business. The company entered that market in 2011, so they've been there about 14 years now. The US is a really large market, so with a loan book of $500 million, Propel is tiny. There is tons of runway left in this market, and the company continues to add new states and grow pretty quickly. As I mentioned, they're also in Canada, not a big part of the story, so I'm not going to talk about that. Their UK acquisition, on the other hand, is really important. They bought a company called QuidMarket. It came with a small loan book and a team. But what it really came with was a platform for them. So what they're doing now is they're bringing their technology, they're bringing their capital to the UK market. The UK market is really fragmented, and I think once Propel brings all their resources, you're going to see exceptional growth in the UK. Management has publicly talked about 50% revenue growth in the UK this year and 100% revenue growth in the UK next year. What that means in numbers is probably about $100 million of revenue for a new market, which is pretty good. Aside from expansion in these three markets, they're also adding new products and services. They have a business, which you may laugh at the name, it's called Lending as a Service. I know everybody's calling everything as a service these days, but it actually is lending as a service. So what they're doing is they're allowing other buyers of loans to use their technology and their resources, and they're charging a fee for that. So it's actually a great business because they're using existing resources, and with no additional capital, they're generating very high margins. So it's a small part of the business, but it's growing. I think you're going to hear more and more about it over the next couple of years. Lastly, I think, when we look at the financial metrics, which we're going to get into some of the growth metrics on the last slide, I'm going to use the most basic metric right now just to summarize this company. Let's look at revenue growth. In 2018, the company did 60 million of revenue. In 2024, they did 360 million of revenue. So really simple math. The revenue's gone up 6 times in 6 years. Pretty impressive. Profits are growing even faster. So let's get into valuation now. How much is the growth worth? And that's what investors seem to be having a hard time figuring out. So when the stock was at its peak, it was trading about 12 times forward earnings. At its trough in 2022, trading about 4 times forward earnings. The interesting thing is the metrics were all going like this the entire time. So we've had huge dislocation between the operating performance of the business and the share price, hence the opportunity. I could go on and on about valuation and comps, and we don't really have time. We'll leave that for another day. But needless to say, when you have a stock that's growing at 30% a year, that's trading on 6 times earnings, everybody knows it's cheap relative to the growth profile. Talking a bit about catalysts, there's a lot of ways the stock goes higher over time. I've mentioned a few of them: new geographies, new products, new partnerships, off-balance sheet opportunities, acquisitions, and overall improved investor awareness, I think, are all catalysts that are going to drive this name higher over time. So let's get into the financials a little bit, and I'm not going to get super granular because I know it can be hard to see on these slides. So what I've shown here is just the top and bottom line growth that I keep referring to. You can look at the numbers. What I've shown you here is last 3 years plus forecast for this year and next year. And what you can see is we're forecasting 37% annual growth in revenues, 58% annual growth in profits. So if there's anyone in the room that can show me another company like this, I'd be pretty impressed. If there's anyone in the room who can show me a company like this trading on 6 times earnings, then you have to call me because I'll be really interested. It's very tough to find. Chart on the bottom shows you kind of 2 other key metrics that I like to focus on here. One is the loan book growth, and then on the bottom you have my favorite metric, return on equity, and you can see that return on equity is very high and very consistent. So going back to where we started when I was telling you what I look for in stocks, this is exactly what I'm looking for. A lot of investors like to use baseball analogies when they look at stocks. They talk about a fat pitch or a perfect pitch. I think that's what we have here right now with Propel. If you're a growth investor, you love the growth. If you're a value investor, you love the valuation. If you're a yield investor, you like the dividend. So there's really something for everybody here. What we have is a highly scalable business. It's already operating in several large addressable markets. Revenue is growing really fast. Profits are growing even faster. All the operating metrics moving higher over the past year, but the stock's been almost cut in half. Multiples now 6 times earnings, like I said. We have a highly profitable small cap name. It's not being priced correctly by the market. I don't think that's going to last very long. I'm going to leave you guys with a couple more numbers just so you understand how I look at this business going forward. Consensus EPS for next year is $4 a share. The company's been growing about 35% a year, but let's say we cut the growth rate to 25%. So we have $4 of EPS, it's growing at 25% a year. Within 4 years, that'll get you to $10 a share of EPS. What will that be worth at the time with that growth track record? Probably about 10 times earnings. It's $10 of EPS, 10 times earnings. I think this is a $100 stock within 3 to 5 years. Worst case scenario, it's probably a $60 or an $80 stock. So I definitely think it's worth looking at. And looks like I have 10 seconds for questions, if anybody has any. After? Okay. Well, thanks very much, everybody. Hope you enjoyed it and enjoy the rest of the conference.